For more on oil and what's driving prices higher, we're joined by Bill O'Grady, Chief Market Strategist at Confluence Investment Management. He says inflation concerns may be a factor. He joins us now from St. Louis. Bill, welcome to Bloomberg News.
Thanks for having me, Mark.
First off, let's talk about where oil is at right now. We've been seeing it break that $70 a barrel range. And NYMEX crude, as we can see for the one-year chart, it is down significantly. Right now it's at 73.79 for the year. Talk to us about that. What are the inflation concerns?
Well, basically the way I have been describing it is I think you have to separate out the concept of oil demand from the concept of oil consumption. If you look at the basic supply and consumption fundamentals in the world, it's pretty difficult to justify prices above 70. In fact, it may be difficult to justify prices much above 30. The problem that you've got is that we are sitting on significant inventory levels in oil and all the related products. You've got very slack demand. U.S. refinery capacity utilization is about 85%. It's been running at that level for most of the year and been, frankly, the weakest level of refinery utilization I can remember in years. And so you've got this separation between what we're seeing on consumption and then the prices. And I think there are two factors underlying this. The first is that really starting in about 2002, but it really began in earnest in about 2004, commodities became an asset class. And so if you were a pension fund manager or a money manager and you were trying to put an asset in your portfolio that would help dampen or resist inflation, commodities was a really good way to add to that. It also was a way of tapping into global growth. So you've got investors seeing the amount of fiscal and monetary stimulus done not just here but globally and worried about future inflation have started to move funds into commodity indices, and oil is benefiting from that.
Right.
The Chinese are doing this too, and that's the other interesting part of this. China has made a lot of noise about being uncomfortable with the dollar, and they hold almost $2 trillion in foreign reserves. About 70% of that is probably in dollars. One of the ways they can diversify their dollar assets is to move from treasuries to commodities. We have seen a significant spike in commodity inventories in China of all sorts of different commodities. We also know they're building additional strategic inventory reserves for crude oil.
And Bill,
that will be a factor going forward. I'm sorry, go ahead.
And Bill, might I ask, because we had a guest on earlier, and we noted that bulls and bears are in quite a struggle right now in the oil. But talk to me about who is in charge of this. Who's really controlling this? Is this a question of fundamentals, or is this a question of speculators being in control?
Well, I think you have to be very careful with both terms. The reason I make the differentiation between supply and consumption fundamentals is an investor buying crude oil or any commodity is part of demand. And to say that this is mere speculation, I think, muddies the waters. In effect, the question that should be being asked not only in New York but also in Washington is why would anybody in their right mind want to hold part of their savings as crude oil and corn and soybeans and copper? And the reason, I think, is that they are fearful that in the future that the U.S. and other countries are going to take steps to debase their currencies, and thus they want to own commodities as a way to counteract that. I've been involved in the commodity market since the mid-1980s, and for the first 15 years of my career, there was really nobody wanting to own commodities this way. In fact, holding commodities in inventory was considered a bad thing. It was the period of low inventory and just-in-time behavior. But a number of factors are involved with this, but one of the key factors is fear of future inflation, and those concerns, just like in the 70s that drove my parents to hold cases of corn and green beans in the basement, is kind of the same factor that's affected here.
Bill, we have about 30 seconds left. $85 for oil. Is that realistic between now and the end of the year?
If you continue to see the equity markets rally and you continue to see policy remain stimulative, not only in the United States, Europe, but also in China, it is a distinct possibility. It's going to start to crimp growth if that happens, but it is something you can't discount. If, on the other hand, we start to see evidence that stimulus is going to be withdrawn, I suspect it'll be difficult to get there.
Bill O'Grady of Confluence Investment Management joining us this afternoon from St. Louis discussing oil. Bill, thanks so much.